2022 has certainly been a year to forget for mainstream investors. As of the end of May, global equities and bonds are both down nearly 15% on the year. But rather than focus on the short-term ups and downs of the market, in this short video I want to ask a much more fundamental question, and that's whether the rules of investing themselves have changed significantly. You see, over the last 40 years, we've had a period of low and stable inflation, and that's made it relatively easy to construct a good performing portfolio just from 60% equities and 40% bonds. During the good times, equities rose and bonds trod water, but during recessions, bonds bailed out equities by rising significantly in value. But the problem is, in a period of inflation, this inverse relationship can no longer be taken for granted. In fact, in a very important research report published recently by the hedge fund group Man and Duke University, they looked at 8 different inflationary periods since the Second World War, and they found, alarmingly, that equities and bonds both produce negative returns during inflationary periods. In fact, the only 2 asset classes that produced positive real returns during these inflationary periods were commodities and collectibles. Collectibles like art, stamps, and of course fine wine produce real positive returns of 5 to 9% during these inflationary episodes. And that's led some commentators to dub the coming decade the tangible 20s, because unlike the previous 4 decades, we might see a period where tangible, i.e. hard assets, things like commodities and collectibles, actually outperform equities and bonds. Our own research backs up the findings of the Man Duke University research. Since it became clear that inflation was far from transitory at the end of 2021, we've seen a clear decoupling of fine wine prices as they've continued to track upwards, even though equities and bonds have fallen quite substantially during 2021. And this outperformance of fine wine is actually part of a very long established trend which we can track back over a quarter of a century. If we look at the performance of major asset classes since 1988, we see that fine wine has actually outperformed them all on a total return basis. But this exceptional performance has not come, as in the case of, say, a cryptocurrency, with excessive volatility and huge drawdowns. In fact, the volatility of fine wine returns has been only that of fixed income. And that's given fine wine a Sharpe ratio better than almost all mainstream asset classes and second only to US Treasuries. So fine wine has given equity-like returns with fixed income-like volatility. And the story gets even better for fine wine because our research shows almost no correlation between fine wine and mainstream asset classes. This means it can be added to a portfolio and can have the effect of raising risk-adjusted returns. So if this decade really is to be the tangible 20s decade, when hard assets like commodities and collectibles outperform financial assets, then we would urge people to consider a small allocation to fine wine as part of a tangible portion of the portfolio. We've seen in this video that fine wine's delivered exceptionally strong absolute returns. It's shown extremely low correlation with other mainstream assets, and it's produced those returns with very low volatility and extremely high Sharpe ratio. If you're interested to know more about how you can take advantage of these positive characteristics and make an investment into fine wine, I'll leave some links in the description below. Many thanks for watching.